there is some noise around the market about the issue of how growth assets and defensive assets play within super fund returns. What are your thoughts on that?
Yeah, this is really an issue. Retail funds invest in a particular way and industry funds, or most industry funds, invest in a different way. And really the difference is how they deal with what they call defensive assets. So they are assets which you're not trying to go gangbusters and earn as much as you can, but you want it as a bit of ballast so that over time that part of your portfolio isn't going to go up and down a lot. So retail funds typically focus on having that in bonds, in fixed interest. Whereas industry funds might have some of that, but they also say, maybe there's a better way of doing this. Maybe we should be investing in, rather than bonds which can go up day to day and also maybe limited in their growth, maybe we should be looking at things like buildings, so big office buildings, commercial buildings, and infrastructure assets. Those assets traditionally have been seen as growth, but the industry funds have a point when they say those assets are a bit defensive as well, because they spin off, many of them, quite a predictable stream of income. So from that point of view, they're a bit growthy, but they're a bit defensive as well. So the industry funds will say, these assets, we're going to treat part of them as defensive. But the question is, how defensive are they really? And indeed, there's a wide range of practice with industry funds. About 40% of industry funds say, no, it's too hard to work out how defensive they are, so we'll go all growth. About 45% of industry funds say, maybe they're about 50-50, and the rest do something else. There's a lot of inconsistency between funds. One fund might say, we have a 70-30 fund, a balanced fund, and we have investments in shares, property, so shares, listed property, bonds and cash. But an industry fund might come along and say, we have a 70-30 fund as well, but some of that 30% defensive is in buildings, property, infrastructure. And what's happened over the last really 15, 20 years is that's done so much better than bonds. So the industry funds seem to be ahead. The question is though, are they ahead just because they're taking on more risk? Even the industry funds themselves have different ideas amongst themselves. So we need to get greater consistency, of course. So the ultimate goal is that each fund shows these sorts of assets in a similar way. So that each fund we can say, here's a 70-30 fund and here's a 70-30 fund. They might invest in a different way, but you know what? They are similar and there's an agreed way of doing this.